Tiger, which is part owned by Singapore Airlines, says it's now looking at setting up new carriers. Who better to talk about the company's plans than the man at the top, Tony Davis, the CEO of Tiger Airways. He joins us here in the Lion City. Congratulations.
Thank
Profit.
you. Yeah.
Hey, so does it mean that the worst is over for the airline industry?
Well, I don't know about the airline industry as a whole, but certainly for Tiger and for low-cost airlines, I think we're seeing it's a good market for us. We've seen, with the results we've announced, a 23 million operating profit on just a turnover of 140 million, so 17% operating margin, pretty good. Our fares have come down about 19% year on year, 54% more passengers. So the model that we've adopted, which is low fares, continuously pushing down our costs were down by about 16% over last year. Push your costs down means more low fares, more passengers, more growth, more profits.
But consumers are getting more confident as well. I mean, the economy is showing signs of recovery. Will they ditch budget airlines, go for the full fare now?
Well, look, Australia has been an interesting market for us. We've had a lot of skeptics in Australia. A lot of people said, you know, you can't make it work in Australia. We are a different model to the incumbents. We are a very, very cheap airline. And we've announced today that we've had 2 quarters of profit in Australia. And I think, you know, 6 months ago, people were saying it's impossible. So I don't follow that logic. I think consumers are very savvy. I think they want cheap airfares. It's been proven in the States. It's been proven in Europe that ultimately people don't really like spending a lot of money on their airfares, particularly on regional travel, on short flights.
So what kind of passenger numbers are you looking at then? I mean, you're so optimistic.
Well, look, we've already said we've advanced deliveries of aircraft. We've taken advantage of some of our competitors who perhaps aren't as confident about their business models. We're going to grow our business by almost 100% over the next 2 years, because we're going to grow from about 18 aircraft today to 33 aircraft. So
passenger numbers, Tony.
Yeah, but, you know, forecasts are always a bit suspect. What we are doing is adding a lot of capacity to our operations, as I say, growing the fleet from 18 aircraft today to 33 over the next 2 years. You've seen 54% year-on-year passenger growth. You know, we're going to keep growing our business. That is our model. It's a volume business. It's about adding more seats, reducing the unit prices, more low fares for consumers, and that is the model.
You also said you want to set up new carriers. What's that about? What do you have in mind?
Well, look, we've said to investors that we believe in sequential profitable growth. We're a business that's focused on profit. Both our airlines today are profitable. Singapore has been profitable for 3 years now. Australia has turned profitable after just 18 months of operation. So as we've made those airlines profitable, we'll look at new opportunities.
Where?
I'm not going to announce today, I'm afraid. But, you know, we're looking around the region now.
Southeast Asia? North Asia?
All of those. You know, we're looking around. I mean, the reality is that there are many people around the region now saying, you know what, we like Tiger's model. We see it makes money. We get it. We want to be part of it, and we're happy to partner with you. So we're looking at the opportunities. Now that Australia is profitable, we can start focusing on the third airline for the group. We're not into flags in the map. We're not just going around Asia putting flags in and saying it's ours. We're about sequential, profitable growth.
Okay, so Australia has turned out really well. China, a very important market as well. Consider deep pockets as well as, you know, the rich and people willing to travel. What are your plans for China?
Well, we've already got an extensive network to China. We've just started service to Hong Kong, so our 5th destination in China. And it's a market we want to grow, both from Singapore and ultimately from other points in Asia. So,
what kind of growth are you looking at in China?
Well, we've said that we're looking at another 3 or 4 destinations in China. We'd hope to bring some of those online this year. I think China is a very logical market for us. Obviously, Singapore has good cultural and trade links with China. We have an open skies agreement between Singapore and China. And as I said, 5 routes already, more to come.
The trend that we're seeing right now is that low-cost carriers are banding together, forging alliances. Is Tiger Airways considering something like that?
No.
Why not?
Look, I mean, if you...
That's one way to cut costs.
Yeah, but you can do it organically, and you have control, and you make the decisions. We've already seen that some of our competitors have supposedly joined forces. Within a couple of weeks, they're competing with each other in some markets, and one of them's buying a completely different engine to the other one. That's not cost efficiency. What I'm looking at is organic growth. I think it's controllable. It means that we make the decisions. We're not reliant on someone else trying to convince us to do what they want to do. And we're able, the market here is big enough. It's 6 times the size of the European Union. It's big enough for us to grow very large organically on our own, make the decisions, you know, produce results like you've seen with this quarter, because we control the cost base, and that is absolutely paramount for this business.
We waited 5 years for you to IPO. Your stock's not doing well since debut. Why? Down 7% since then.
No, it's only down a couple of cents. It's
still down. What's the story
you've got to
there?
look at the market, and this is the first set of financial data that we've provided to the market since the listing a month ago. Everything else that's happened up until now is really a factor of the market, and as you know, the markets over the last month have been a bit choppy. What we're putting out today is our first financial statements to the market, and they're very solid. A 17% operating margin, 23 million of profit on just 140 million of turnover for the third quarter. The only exceptional item that we had in our books below that was the IPO expenses. It's a very, very good result. So I think that will help give confidence to investors. They're starting to see some real numbers from Tiger now. We've outlined our growth plans, and as we continue to give the market more information, I'm sure that they'll see that this is a business that not only produces good profits but has tremendous growth opportunities.
In 20 seconds, can you outdo those numbers? How confident are you?
Well, we can certainly grow our business. We're still very small. 140 million turnover for the quarter is still very small, but we made a 17% operating margin on a small base. Australia coming profitable is a big step forward. Third airline in the group will be another big step forward. 70-odd% aircraft growth over the next 2 years will be another big step forward.
Tony, we'll
leave
it there. Good luck, by the way. Tony Davis, Tiger Airways President and CEO.